Welcome to the Tesla Daily News podcast for December 11th, 2025. I'm your host, bringing you the top developments transforming Tesla's business and what it means for your portfolio. Tesla stock closed yesterday at $451.45, posting a solid gain from its previous close of $445.17. That's an increase of $6.28, or roughly 1.4%, as shares traded in a range between $443.61 to a high of $456.88. Coming up on today's show, we'll break down the strong rebound from Tesla's Chinese operations, examine possible catalysts in the AI and robotaxi segments, assess the relaunch of Tesla's solar leasing, review impressive sales growth in Taiwan, and dig into analyst expectations for 2026. We'll also touch on competition in Europe and whether Elon Musk's recent decisions are steering investor sentiment. Let's jump in. First up, Tesla Shanghai delivers needed growth in a tough market. Tesla's Chinese unit recorded a 10% increase in shipments for November, a significant positive in what's been a highly competitive and price war-ridden Chinese EV market. The challenge for Tesla has been coping with rising competition from local players like BYD and Leapmotor, both capturing more domestic market share, while Chinese EV demand growth slows post-incentive phase-out. Despite that, Tesla's Shanghai exports and domestic sales rebounded solidly last month. For investors, this signals resilience in international operations that could support global delivery numbers, especially as headwinds continue in North America and Europe. Keep an eye on China volume. The region remains crucial for Tesla's annual growth and bottom line. Next, renewed enthusiasm for Tesla's robotaxi and humanoid AI business in 2026. Analysts at Deutsche Bank are spotlighting Tesla as their top 2026 pick, not for near-term car sales, but for long-term potential in humanoid robotics and fully autonomous ride-hailing. The thesis: if Tesla launches fully driverless robotics or shows credible progress in humanoid robots, the company could access entirely new multi-billion-dollar businesses with high margins. The context is slowing EV demand and margin compression right now, but early traction in these adjacent tech markets can drive a re-rating of the stock, even if vehicle growth lags. For investors, this means paying attention to autonomy milestones. Even incremental advances could trigger renewed enthusiasm in the stock. Third, Tesla returns to the solar leasing market. In a move that surprised some, Tesla has re-entered the home solar leasing business as 2025 comes to a close. As the company ramps up bets on renewable energy and AI under pressure from a potentially changing U.S. regulatory environment, a reboot of solar leasing could drive top-line growth. This signals two things. First, Tesla hasn't abandoned its energy strategy despite recent emphasis on AI and EVs. Second, the move opens fresh opportunities for suppliers in the region, notably Taiwanese firms. Success here could provide a cushion if EV profit margins remain under fire, and it means the energy business remains an essential, if sometimes overlooked, part of the Tesla growth story. Fourth, Taiwan emerges as a bright spot for Tesla vehicle deliveries. Tesla recorded a remarkable 70% surge in deliveries in Taiwan for the current quarter. All in-stock Model 3 and Model Y vehicles have sold out for quarter 4, and local reports expect more than 6,000 cars delivered in December alone. The robust shipment cycles and growing regional appetite, especially for the Model Y, help offset slower growth in established Western markets. Yearly deliveries in Taiwan are forecast to top 15,000, matching last year's record. For shareholders, this supports the bull case that Tesla is still finding fresh pockets of growth globally, even as competition intensifies. Now let's zoom out to Europe. Chinese EV makers and legacy automakers tighten the race. Recent market data shows European electric vehicle sales rebounding sharply, led by Volkswagen, but also bolstered by the rapid expansion of Chinese brands like BYD and Leapmotor. Tesla, however, slipped in market share, raising flag for analysts. The context: Europe is emerging as a battleground as both local and Chinese players target the continent with aggressive pricing and more options, pressuring Tesla in a region once considered a stronghold. The implication for investors is clear: a more crowded and price-competitive landscape could squeeze margins and force further innovation or price cuts to maintain share. Staying in the realm of competition and perception, CEO Elon Musk's recent admissions about his controversial government role have made headlines. On several major platforms, Musk reflected that he would not reprise his role as head of the Doge Government Efficiency Department, describing it as only somewhat successful and noting the distraction from Tesla and his core companies. For shareholders, this could be a modest positive, signaling Musk's renewed focus on Tesla at a time when leadership consistency and vision are being reprioritized by analysts and institutional holders alike. Musk's message: expect him to double down on strategic initiatives rather than outside distractions as Tesla pursues its ambitious product and tech roadmap. To wrap up, here are your key takeaways. Tesla's Chinese and Taiwanese businesses are delivering much-needed volume growth, with November and Q4 off to a strong start. The energy business is back in the picture, opening new growth levers. The long-term bull thesis is increasingly focused on autonomy and robotics, but competition in Europe and ongoing margin pressures can't be ignored. Finally, Elon Musk is recommitting to core Tesla leadership, which may reassure investors after a stretch of mixed headlines. Tomorrow, watch for more on December delivery numbers, ongoing updates on driverless robotaxi launches, and any signals on EV pricing pressure into year-end. Don't miss the next episode by subscribing. Follow us for your essential daily edge on the Tesla story.